Scott Schweighauser, in the wake of what just happened with the Fed and their decision to keep rates where they are, why do I want to own a liquid alternative fund like the Aurora Horizons Fund?
Well, Greg, now is the perfect time to own a multi-strategy fund that's focused on providing investors with a more balanced approach to investing capital in a number of different trading strategies, most of which have very little dependence on the direction of the market. So if you look at the things which have done well for us this year, our portfolio hedge component focused on short selling of securities is doing the best. So we have a lot of tools at our disposal to allocate capital to areas that are very abundant with opportunity.
That said, a lot of hedge fund managers, the big names out there, aren't having a great year so far in 2015. And one would think with all the volatility that their hedging and their stock picking and their shorting would work better. Why hasn't it?
Actually, I'm not sure that that's uniformly true. Our experience has been that there have been a number of strategies abundant with what we call alpha-rich returns. And so if you look at sector specialists, people who can focus on a particular sector like healthcare or energy, they can mine both longs and shorts to come up with positions that are going to do well independent of market direction. And so what we see is as we go forward, and especially with the volatility that's being created because of uncertainty regarding China, what's happening with interest rate policy here in the US, that there is much greater dispersion among equities, and that will benefit a long-short approach.
Has it been the problems in China that have tripped up a lot of the, perhaps just the big name hedge fund managers out there? They weren't expecting it. Is it a macro thing?
Macro influences have been dominant as part of the investment landscape really since the financial crisis of 2008. As we go forward, the influences of Federal Reserve policy, you know, the quantitative easing that we've seen, and especially as we go into 2016, we do expect that rates will rise. I know that yesterday they decided to play kick the can yet again, but as we go into 2016, we think that interest rates will normalize. It'll create a better environment for equity dispersion, and that will be right in the wheelhouse of our managers.
Okay, so are you going to be making any changes to your portfolio because of what the Fed did, or because you foresee rates actually moving higher?
Well, not really responding to the Fed action yesterday, but forecasting that we are going to have higher rates, that global economies are going to be moving at different speeds, that equity dispersion will be the dominant factor. We are increasing our long-short equities component. We are increasing our event-driven component. Those will still be very large allocations of capital. We think macro has the ability to really drive performance because trends ought to emerge that reflect the different economic influences that are taking place in the world today. Commodities would be a very interesting place to be because, you know, with the China slowdown, you would expect that, you know, industrial commodities like oil and copper and things of that nature will be under pressure.
All right, and then just one reminder about how Aurora manages its assets compared to a lot of the other liquid alternatives out there, because for a while you were seeing new liquid alternative funds hit the market. It slowed down of late, but how are you different from the other ones out there?
Well, I can't speak to how other people run their funds, but you know, we're very active with our managers. We want to identify managers that we think are best in class and have the best ability to be very nimble in volatile markets. And so we're constantly scouring the universe of managers looking for people who can be great stewards of our capital. We've had a bit of turnover in our portfolio this year to shift the portfolio into the hands of managers that have greater nimbleness, more of a market neutral approach. So we're steering away from more beta related exposures in the portfolio.
All right, well, thanks a lot, Scott.
Great to see you.
Thank you for watching The Street.